All right, folks, welcome. If you're looking to dive deeper into the crypto markets, you've come to the right place. Today, we're tackling a topic that might sound complex, but is absolutely crucial for anyone trading crypto futures. I'm talking about funding rates. Crypto futures allow you to speculate on the future price of digital assets like Bitcoin or Ethereum without actually owning them. This opens up a world of possibilities for traders, but also introduces new concepts you need to grasp. Many traders, especially those new to the scene, often overlook the subtle yet powerful impact of funding rates. Perpetual contracts are a special type of futures contract that, unlike traditional futures, don't have an expiry date. But this no expiry feature brings its own set of mechanics, and funding rates are at the very heart of how these instruments function smoothly. We're going to break it all down, piece by piece, so you can trade with more confidence and knowledge. Funding rates are not just a minor detail, they are an integral part of the market structure for perpetual swaps, influencing your profit and loss over time. So let's get ready to demystify them together, making you a more informed crypto trader. Think of this journey into funding rates as learning the rules of a new game. Let's get started. So what exactly are these funding rates we keep mentioning? In simple terms, a funding rate is a periodic payment made either to or by traders who are holding active positions in perpetual futures contracts. These payments are exchanged directly between traders holding long positions and traders holding short positions. The primary purpose of this mechanism is to keep the price of the perpetual futures contract tethered closely to the underlying asset's spot price. Without funding rates, the futures price could drift significantly away from the actual market price of the crypto. Funding rates act as an incentive or disincentive to push the perpetual contract price back towards the spot index price. If the perpetual contract for Bitcoin is trading at a premium to Bitcoin's spot price, long position holders will typically pay a funding fee to short position holders. Conversely, if the perpetual contract trades at a discount, short position holders will pay the longs. This regular adjustment helps to prevent large sustained deviations between the futures and spot markets. Understanding this core purpose, to anchor the perpetual future to its underlying asset, is the first major step in mastering how these rates impact your trading decisions and overall profitability. Let's make this crystal clear with a straightforward example. Imagine Bitcoin is trading on the spot market at $70,000. Now let's say the Bitcoin perpetual futures contract is trading slightly higher, perhaps at $70,050. In this scenario, the funding rate will likely be positive. A positive funding rate means that traders holding long positions will pay a fee to traders holding short positions. Conversely, let's consider the opposite situation. Suppose the Bitcoin perpetual futures contract is trading at $69,950, while the spot price remains $70,000. In this case, the funding rate will likely be negative, meaning short position holders will pay a fee to traders holding long positions. This mechanism ensures that there's always a cost or benefit associated with diverging from the spot price, constantly nudging the perpetual contract back in line. Section 4. The nitty-gritty payment mechanics and key influencers. Understanding when and how funding rates are paid is crucial for managing your trading account effectively. Typically, on most major cryptocurrency exchanges, these funding payments occur every 8 hours. If you are holding an open perpetual futures position at one of these specific timestamps, you will either pay or receive the funding fee. Several key factors influence the funding rate. The primary driver is the price difference between the perpetual futures contract and the underlying asset's spot price. Market sentiment also plays a huge role. Leverage levels in the market can also indirectly affect funding rates. The exchanges calculate the funding rate based on a formula that usually includes an interest rate component and a premium or discount component. Section 5. Trading with insight. Using funding rates and avoiding pitfalls. Savvy traders don't just see funding rates as a cost, they see them as a valuable piece of market information and even a potential source of trading opportunities. One common strategy is funding rate arbitrage. This involves taking opposing positions on two different exchanges or on two different instruments, like a perpetual future and a dated future, where funding rates create a profitable differential. Beyond arbitrage, funding rates can serve as a sentiment indicator. Persistently high positive funding rates often suggest that the market is overly bullish, with too many traders piling into long positions. Conversely, deeply negative funding rates might suggest extreme bearishness, potentially signaling that a bottom is near. Monitoring the trend in funding rates can add another layer to your market analysis, helping you gauge the prevailing mood and potential turning points. Section 6. Staying ahead, tracking rates and your next steps. Most major cryptocurrency exchanges that offer perpetual futures will display the current funding rate directly on their trading interface for each specific contract. Beyond the exchanges themselves, several third-party data aggregators and crypto analytics websites provide comprehensive dashboards for tracking funding rates across multiple exchanges and various cryptocurrencies. Sites like CoinGlass, Skew, now part of Amber Data, and the Block Crypto often have dedicated sections for funding rate data, historical charts, and comparisons. These resources can be incredibly useful for getting a broader market overview, identifying trends in funding rates, or spotting potential arbitrage opportunities. So, to summarize the key takeaways, funding rates are essential mechanisms in perpetual futures markets, designed to keep futures prices aligned with spot prices. They involve payments between long and short traders, not to the exchange. Positive rates mean longs pay shorts, negative rates mean shorts pay longs. Always check the current rate before trading and be aware of when payments occur.